Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about Jobs Week and why that jobs data is so important for mortgage rates. Logan, welcome back to the podcast.
It is wonderful to be here. Brand new year. It's going to be a bigger, badder chart daddy for 2025. We're going to bring it with new energy. So it should be a lot of fun. Sarah.
It is going to be a lot of fun. Okay, before we dive into our topic, I know you are celebrating recently because you feel like the new year has brought some people got clarity around being people who just post doom things, right?
Yeah. So what did we talk about right after Trump won? You remember?
We talked about a lot of stuff. Right
yes,
after
but I also said that I've done this dance before. By the way, I am Switzerland. I am neutral. I don't do political economic theory.
It's true.
So I've found out that people go into some strange, dark trolling cave when they believe in political ideological stuff first, and it's just not a very useful thing. So as an analyst, you almost have to become as less human as possible. AI version of Logan, whenever it comes out, it's going to be pretty neat. But here, one thing I did the same thing back in 2016 when Trump won. Half of the doomers are usually conservative, anti-central bank people. So half of them had to go bullish, and the other half are the true believers, and they just hate everything. So what happened recently is Nick Gurley, the bubble boy. By the way, a lot of them are in Dallas, Texas. I just want to let you know, Sarah,
I don't know.
you have a lot of doomers. You have a lot of doomers in Texas and a lot of doomers in Florida, and they have one thing in common: they're all anti-central bank people. But Nick Gurley gave up, cried uncle. Went from 40% home price crashes, everything's 2008 to home prices will be up slightly, which we talked about. This is going to happen. There's some of them are going to have to turn, and one of the reasons is it's not just him. There's a few others that this is media. This is basically eyeballs. And when Trump's now president, you can't alienate your conservative viewers if you're doing doom all the time. So you're going to have to flip, right, to generate, because it's all about clicks and getting people in. So we said this a few podcasts ago that some of them will turn, not all of them, but some of them will turn. And it's not just him, a few others have turned. We get them back into a world of just actually trying to forecast. But I just think now that Trump has won, you don't want to alienate your followers. It's nice to see that some of them are back to reality. Some of them aren't. Some of them are just still everyday world's terrible, but right on cue, right?
Okay, well, let's get into some of the biggest news coming. Jobs Week next week. New year. Are we going to see, what are we going to see next week?
Jobs Week is the same week the Nerd Tour starts. We're going to be in Utah in 5 days. By the way, I feel bad. We have 27 cities already. It's, and we've already surpassed 2024. I apologize. There are people out there who try to set us up, and we've already had something booked. So I encourage everyone, press@hwmedia.com. Caroline's my boss. Sarah's the other boss. If you need something in the middle and back end, you got to get early, or else you're running into schedules. We're try to fit everything in. This is going to be a crazy year for me, but get it in early. And just remember, Dallas, Texas, February 26th. That's the main economic event. We have all these economists and analysts all in one day. That'll be the most prolific event for 2025, because you don't usually have everyone into one place in one day, and you have so many different views. That'll be good. But if you're trying to get the chart daddy in your city, get in early, or else you're going to, get the X because it's already been booked.
That Dallas event, we are so excited about. Brenna and I meet on a regular basis to think about, the last couple of speakers and last couple topics. We wanted to keep a couple things open because as the new year comes through, we know that there's some new things coming up. But we are super excited. That is going to be the must-attend event for anybody interested in how they're going to run their business in 2025. So you're going to be our keynote. Mike Simonson's going to be there. Barry Habib's going to be there. All these economists that we can't wait to hear from. So it's going to be amazing. Okay, Jobs Week. What do you expect?
So here we are. I wrote that article, right? Jobless claims mortgage rates, right? Paper, rock, scissors. labor over inflation. The growth rate of inflation has fallen so much that we got that little bounce that you typically get at some periods of times because, the Fed they made up a number about 2% targeting. So that's their goal. And we're still here with 7% mortgage rates. Why? Because the labor market has not broken. Whenever the labor data gets softer, Fed, 50 basis point cut. We got to get ahead of it. We got to, but here, this job was weak. We're going into 2025. And that article that I wrote was trying to highlight, now, what do we look at for labor and economic cycles? There are things to track, right? Jobless claims heading down to up to 323,000 at 4-week moving average. And I'm telling everyone, some of you are listening to people who think the data is fake. The data is not fake. They don't... Think about the cabal that it would be, that somebody would actually come out and say, hey, by the way, we fudged the numbers. No, you're letting your personal ideological take over. No, the data you wouldn't have GDP and consumption data if the labor market was breaking. So we always say labor data breaking is different than softening. So track residential construction workers, track manufacturing data. These tend to be the kind of the boom and bust labor sectors. But now that we're going into 2025, there's not much wiggle room left for the Fed's unemployment rate, right? It's like 4.3% is their forecast. If it goes above that, then in their own eyes, the labor market got weaker than what they were accustomed to. So they left themselves a very low bar to change their tune. So this is the last report for 2024. We go into 2025, and labor data is getting softer. It's more concentrated, right? Private payrolls. If you lose one sector, even if you're creating jobs, the unemployment rate can get higher on them. So this is kind of the mindset for 2025. This is the last report for 2024. We go into it, and remember, we're going to track things daily and let everyone know, because once something turns, what we've seen in the data now for the last 2 years, once mortgage rates get down to 6%, people come in. And, demand picks up. And I think versing yourself with that and understanding your clients and everything, you got to prep people for that, because nobody's going to sit and wait for you to make your decision, right? People go, I'm going to wait. And nobody cares what you do. The marketplace overrides everyone. And that's what we've seen, since late 2022, how the data operates.
You made your point in your recent article, which you have always talked about when it comes to looking at specifically construction data and the construction workers who's losing their jobs. You're like, listen, the existing home sale market has been in a recession since 2022. But when you look at the new home construction, when those construction workers start to lose their jobs in any sort of big number, that can turn the whole economy, correct?
Essentially, what occurs before a recession is that we see residential construction. And you have to remember, this is also remodeling, right? People, it's not just apartments and single family, it's remodeling. And, some people can make a case, well, now that the Fed funds rate is lower, household balance sheets are good, the remodeling business is still there. Last year when Home Depot and Lowe's warned, that was, a kind of a heads up trigger. So we keep an eye on the remodeling sector. It's a little bit different than the residential, because now as we have completed units picking up, right? And then it's like, okay, well, permits aren't growing. Permits are down. Starts are down. What do these people do, right? And every single cycle in recent modern day history, you take COVID out of the equation, of course. When this falls, the Fed tends to ignore it, right? They'll give up all their reasons. I remember all the reasons in the 90s, 2000s and the great financial. They appear not to care about that data line, even though it's correlating to something very well. So if you follow history, the Fed will kind of ignore this. We're all the data miners are here trying to help the Fed staffers, because you can't have another one of these things happen. And then all of a sudden people go, wait a second, you are supposed to be the Federal Reserve. You are supposed to have trained analysts. What were you thinking here? Because it happens all the time. So that's why I try to get people to focus on that data line. In that article, it's very evident. And it's not shocking. Think about it. Rates go up, policy is restrictive, labor data growth slows down. all of a sudden, one or two sectors, again, there's your recession. So we keep an eye on that. And this way, it moves with real-time data. Instead of this, oh my God, all the job data is fake and everything. And now, no, that's not how it works. So we're going to track this very, very closely, because what 2025 has is different than the last few years. Last few years, job growth slowing down, right? It was not hitting my targets. I was wrong for a very long time. Once the revisions came in, now it looks pretty much right. We're slightly above where I was looking for job growth creation to be. And remember, population growth slowing down. You can't have these massive big job reports anymore, right? Most people are employed. You get people coming in, you get people leaving, right? It's a wash. That was the whole job openings, 10 million call it for COVID. And we start from here, right? This is the last thing for 2024. We break into 2025 and we take it from there.
What is the Fed looking for to, as what, is there a number they're looking to hit? Is there something that's going to trigger them?
I personally believe they kept the unemployment forecast at 4.3% to give them a low bar. So if it goes like hypothetical, let's just say the unemployment rate is at 4.4% in the next jobs report. Then all of a sudden, everyone goes to the Fed, hey, listen, you're already wrong and it's the start of the year, right? So because of that, they could have easily said 4.5, 4.6, give themselves a little bit of buffer. I just think they took the 4.3%. I think the low unemployment rate for the cycle was 3.4. And then they just say, hey, listen, we believe labor over inflation at this point is a balanced look, right? Dual mandate Fed. And we just track that. And again, some of the things that are different now is that wage growth has firmed up and kind of accelerated. Now, the Fed will tell you wages don't create inflation. And yet there's like thousands of statements. Wage growth is too strong. Wage growth is too strong. We don't like that. Labor data is too hot. Can't say it here and then take it back here, right? So the unemployment rate to me is the big key for 2025, because unless they change it up and say, okay, we revise our unemployment rates, we think it'll be 4.6. I mean, the Fed used to think that peak unemployment rate, and full unemployment would be like 4.7 to 5%. So they have precedent to raise that. They didn't. They raised the inflation targets, or what they believed inflation was going to go, but they kept the unemployment rate low. So we focus on that, because remember, you don't necessarily need to have like negative job reports to have the unemployment rate rise. We've seen that the last 18 months. But if the job growth starts to slow, there you go. So it'll be interesting. That's why I think the 2025 backdrop for labor is a little bit different than the last 2 years.
So you've talked right now about here's how we get towards 6%, because we know, as you said, 6% is where we see demand start to pick up, where the housing market starts really being able to function more normally, because it's just the right the mortgage rate that makes sense for that to happen, at the top end. So, but then in your article, you talked about for mortgage rates to drop below 5.75%, and that's the low end of the HousingWire 2025 housing market forecast is 5.75%, right, in 2025. You outlined several factors. Tell us what it would take to get to that level.
So I can't forecast below 5.75% in this environment because of Fed policy, because of economic growth, the growth rate of inflation. In fact, I could make a case that the 10-year yield never got as high as it should have, like, how it was in the 1990s. And the difference is that this is a pandemic inflation, not a, systemic 1970s stagflation where labor force growth and energy prices and all that stuff. So that's different. But here, what are the things that could get you below 5.75? Spreads get better. Okay, so the spreads getting better in 2024 got us down to near 6% mortgage rates. If the spreads did not improve, we would never have been there, right? Because the 10-year yield never got down to like 3.37 like it did in 2023. So better spreads, right, can get you toward there. And you need the 10-year yield basically around 3.80 to 4%. You get that going to that, you can get below 5.75% because you got the bond yields going lower, and then you get the spreads. The spreads getting back to normal gives you a 70 to 80 basis points a better rate pricing. Now, I've said I've got about a 27 to 41 basis points better improvement on spread. So you're going to need help on the 10-year yield. Those things typically need to happen. And what happens is that the economy slowing down or weakness or market stress, or let's say the stock market has a 10% correction, money goes into, there are things that can get you down there without the labor market breaking. But once the labor triggers start to take off, it becomes a different ballgame, right? Because we have set a very low bar for the labor market, and the Fed will tell you, remember, it's not what I think, what anybody, not what stock traders think. Remember, rule of thumb, we do not listen to stock traders, especially on Twitter, right? They're saying fart coin is up so much that Fed has to raise rates. That's not how the Federal Reserve, that's not how human beings operate. Nobody cares about that, okay? It's the economy itself. So the Fed will tell you they're still restricted, right? The growth rate of inflation is, the Fed funds rate is still above the growth rate of inflation. So it becomes the labor triggers are much more prominent now than back then. So you could get that, you could get sales to grow. I mean, just imagine another hypothetical. Our pending contracts data was getting better months before the existing home sales report and pending home sales report caught it. Just imagine if mortgage rates were at 5.75 to 6.25 starting from December all the way to here and stay there. We are growing sales above everyone's forecast, right? Household formation, another year of wages rising, another year of selling equity growing, right? We showed that one of the charts that I showed that the average loan to value Q3 2024 was 46.6%. 46.6%. Okay, so there's a lot of selling equity. People sell their homes, buy another one. 70 to 80% of sellers are buyers. So we can do this. We just needed to test what rate makes it work, right, for the forward-looking demand to get better and just getting down towards 6%. Which the irony is that was Neil Kashkari's, oh my God, 6% mortgage rates. How are we supposed to balance economy? People are having sex, they're having kids, they're home forming households. Oh my God, what are we going to do? So if we're still in that stage, literally, that's how I explain to other. I'm telling you, that's how I explain the economy. Like people, like here's the thing. This is a good question I get. People go, why doesn't the Fed talk about housing? Like I said, and I get it. Think about it. You had the biggest crash in home sales. You had 3 years of the lowest home sales ever. You have housing starts at recession permits, and they're like, Bueller. No, they're not saying anything. Why? Because Neil Kashkari told you the fear, people having sex, buying homes, household formation. Why does everyone hate America? Because we have a great middle class. This scares them all. It keeps them up at night. You know, a powerful country like us, all of a sudden home sales go, oh my God. So, and you know, they gave you that. So it's not shocking. Rates don't get below 6%, right? The whole thing is that the housing market is a sacrificial lamb. The housing market is COVID-19 policies. You wouldn't see this before, but in this case, this is what it is. That's the best way I could explain it.
So after 2 years, basically, of rising rates, when do you think, when do we see some of the people who've gotten houses in the last couple of years? What is the level that makes a refi, attractive for those people?
It really depends, because you had people in the kind of 7.37 to 8.25 range already, and we did have a little bounce of refinancing going when rates got down to 6%. So you've already had some rate and term refinances occur. I just think that if you are, I think the final number is like over 18%, slightly over 18% are have higher rates compared to what it was before. So the pool of people doing rate and term refinances has taken some of the 7 to 8% loans off the marketplace. So again, talk to your loan officer. Loan officers, talk to your client. Do the numbers right now. So if it happens, you jump on it. If you don't jump on it, what happens? Gandalf, you shall not pass. Rates go up. Hold the door. Rates go up. You got that little window of time, and then some people did it, right? Some people who had 8% mortgage rates now have in the 6s. Hey, life is better. Cash flow is better. But you gotta prep and get ready, because if we have another get down here, the economy doesn't break and rates shoot back up, then that's on all of you, right? We've seen this happen twice now. So if the economy was breaking, 10-year yield falls, rates go lower, stay lower, until the economy recovers. Remember, even in that scenario, you got to get ready. Chomp on it, right?
Well, and we saw that trend in purchase application data where people were, they had that seasonal bounce before coming into the holiday season. So that could be really fun. I mean, there's demand out there.
Speaking of which, what do we always do around Christmas time? We talk about do not take the last 2 weeks of purchase application data seriously. Right. And there's going to be people on the internet that are going to say, "Oh my God, people just stop buying homes." It happens every year. We did it again. The same doomers came on. "Oh my God, our collapse." So one of the reasons why we talk about seasonality is usually the last 2 weeks of the year, total net volume demand just collapses because it's Christmas and New Year's, right? And then the first 2 weeks, it kind of trends back up. That's why you almost should ignore the last two and the first two. This is why I always say that I used to always just wait after the second week of January to the first week of May. But again, the last few years, purchase application data has risen. Whether rates are going down or up, they have risen in this period of time from November, December. That's prepping yourself for the spring. And now we have enough years where it could be a legitimate theory now, not just a hypothetical. Is this a one-off? Is this? See, I could understand that the last 2 years, or 2022, 2023, rates fell, so application rose, so people just went with that, but not 2024. No, rates were rising. And the forward-looking demand got better, and the application data grew. So, if rates had been at 6%, sorry,
I know.
Oh my God, Neil
it's a whole different environment.
He would be panicking. He wouldn't know what to do. He'd be so frustrated. People buying homes again.
I know. And, we saw all this sort of, negative energy about housing, like it bubbled up from Main Street into the campaign. I mean, they had to talk about housing this year, both campaigns, because it was like people they just feel so stuck. Those first-time homebuyers are like they feel shut out of housing. Other people feel like, they're sort of locked in. So it'll be interesting to see, now it's not a campaign year. Is anything going to happen on housing from a federal level?
Listen, this is the honest truth. Mortgage rates are the only thing that changes the variable. You can talk all you want about we're going to build.
So we know that's not going to happen.
Have you heard we're going to build millions of homes? Have you heard that? I've heard it. I've heard it for like my whole life. We're going to build. No, you're not. You're going to build basically on the demand curve. And then that's it. And then when rates go higher, oh my God, look what happened again. Oh, my permits are down, starts are down. When rates go lower, more people buy homes because the cost of housing improves, right? And then the builders go, okay, we can start permits again. That's how it's worked since the 1960s. Okay. This is what it is. If you choose to avoid it, then that's on you.
Yep, that's on you. Okay. Anything else you want to give us in this segment?
No, that's it. I'm just waiting. I cannot wait to see some of you all in Utah. We're going to go to Boise, Denver, Columbus, Ohio, Dallas, Texas is the thing. The chart daddy is going to be bigger and badder and more lively for 2025. And poor Sarah Wheeler's job is going to be harder and harder to try to control me. And we are going to be there 24/7. I do not stop. I do not sleep. I don't really eat that much. And I'm just going to be here trying to get everybody in line of what's really going on.
Okay. For the people who are watching on YouTube, okay, this is a very ski sweater you've got on. Is this are you gearing up for Salt Lake City? What is this?
Listen, I'm a SoCal kid. Okay, I freeze to death in the Albertsons freezer section. I cannot go near that place. Okay,
you're a lightweight.
Everybody that goes to Costco, that little cold area, Costco where the milk is, everything. You put me there for 37 seconds, I am dead. I am Titanic in the water, freezing to death. Okay, so I've had to bundle up and get as much cold because it is going to be cold. Denver, Utah, Boise twice. Columbus, Ohio, Bloomington, Illinois. We're going to Illinois all in the first few weeks. And I was like, oh, I'm going to die unless I get some more gear. Cause we went to Indiana late in 2023. Yeah. And I got a cold that lasted for 6 months. because I did not have proper gear. So I said, I'm not going to let that happen. I'm going to be full Jon Snow. For those that don't know the Jon Snow story, I had a sweater like this in Japan, and literally people thought I was Jon Snow. I had people taking photographs and selfies, and Jon Snow.
Like Jon Snow's character?
I do not look like Jon Snow. Okay, it was just like, okay, we have dark hair. We have like a, maybe, you know, Jon Snow sweater jacket. And then it was just like, okay, then it got awkward. And I was like, oh, God, okay, whatever. Yes, Game of Thrones. Yes, Jon Snow. Yes.
Well, we will see what you're wearing. I'm going to be on that Salt Lake City trip. I won't be on many of these, but I'll be there. Intercap Lending. Looking forward to that event, and we'll see. Hopefully, you'll keep warm. I've got plenty of cold weather gear, so not worried. But Logan, thanks so much for being on today.
It'll be a good time. See you guys all soon.